Hi everybody, James Packham here with an economic and real estate update. A year to the day from the RBA introducing its first interest rate increase, they've just implemented their 11th consecutive interest rate increase of 25 basis points, and that brings the cash rate to 3.85%. For people that don't really follow the economy closely, that cash rate is the price that the RBA sells money to the banks at, and then the banks put on their couple of percentage points on top and then sell to you in the form of your mortgages. So if they want the rates that you're being charged to go up, they increase the cash rate, they pass that on to the banks, and the banks pass it on to you. Now, at the end of the day, the RBA has a principal function to control inflation, and at this stage, inflation is still not under control. I don't think it really was a surprise that they increased the interest rates, because that is their principal function to control things. I think where they're copying most of their criticism now is basically that they did too little too late. They should have started these efforts earlier, and they should have done more earlier as well. So you see a lot of people appealing on the news, talking about how this means they won't be able to take that holiday, or that fewer people will be coming in to spend money in their business. That's the purpose of it. They're doing that very intentionally. They're aware that that will be the outcome, and that is the expectation and the intention behind those increased rates. They want spending to slow down so that we don't have the prices of things running away from us. Now, we do need to control inflation, because inflation erodes the value of your savings and your assets and even your income. If your assets are increasing at 10% per annum, which is wonderful growth, but inflation's 10%, in real terms, you're not actually advancing at all. So we do need to take control of that. So despite 11 consecutive interest rate increases, why is inflation still high? That's the question that's coming out of this. And there's a few things that we need to consider. The first is that there's been a backlog in construction, and there's been supply chain issues that started through COVID, and building materials have become very, very expensive. Some things like timber have jumped, more than 30%, which is a huge cost increase, and that is having an effect. Also, because it's been a very tight labour market, people that are participating in the workforce have been able to demand salary increases, and that's led to more available money coming into the market. There has also been still a very high demand for housing to both buy and rent. Also, staples such as food and power, these things have seen huge cost increases as well. And when the RBA puts up interest rates, their expectation is that people will spend a little less, but they're often thinking about deterring somebody from going out and buying the new pair of runners or that expensive outfit. But actually what's happening is the things that people are spending money on, and what we spend a lot of money on as a nation, are these staples like food and housing and power. And because we spend so much money on those things, they're very heavily weighted when we're measuring the cost increases in items. And so people are still spending a lot of money on those things. They're prioritising them because they can't do without them. And that causes things to appear that we have very high inflation, but they're really non-negotiable purchases, and that's part of the trap of where we're actually caught. We are getting very near the top of interest rates. There could be another one still to come, in my opinion, but what will happen now is we're going to see the effect of people coming off of their fixed-term interest rates having some effect on the market and a bit of a pullback. Traditionally, about 80% of mortgage holders are on variable and about 20% are on fixed. But when rates hit that all-time low, a lot of people took advantage of that and changed over to fixed rate mortgages, about 35% of all mortgage holders. So despite the 11 consecutive interest rate increases, 35% of mortgage holders have not yet felt a thing. but it won't quite be the cliff face event they're talking about, because all of those people entered into those mortgages at different times and will come off them at different times. It won't be 35% of all mortgage holders suddenly being transitioned over to variable. It will be a very staggered approach. It will step up. So you will certainly feel the brakes come on, but it won't be like hitting a wall. It won't be quite the cliff face event that some people are talking about. What's going to happen in the real estate market? Well, we anticipate that prices will still remain high, and this is because of a few things. There is still very high demand for housing. There is very strong population growth. We have a net positive migration into the country. There's very strong investor activity because people are pursuing the very good rental returns that our properties are yielding. And there is not many homes available to buy in the market presently. When people started hearing about some of the markets interstate cooling off, and they started to hear about increased interest rates, a lot of people took that to mean that it was no longer the ideal time to sell, and a lot of people have basically decided to not bring their homes to the market as a result of that. What that's caused is a huge undersupply of homes available to buy, and considering the old supply and demand in real estate, those people that are bringing their homes to the market are actually getting very good prices as a result of that undersupply. So it is ultimately still a very good time to sell and buy. I know it feels like we say that all the time, but the last 100 years has proven that not to be wrong either. So if you've got any questions or you want to chat, just reach out to any of us. We're here to help.